today's episode, we're diving into estimated tax payments, why it's very important to pay those in to avoid penalties and interest. A lot of people are going to be employees, which means they're getting a paycheck every week, every couple weeks, and their federal income tax and their FICA is being withheld each time payroll is ran, which basically means they're paying in their tax evenly throughout the year as they earn their wages. For those who are self-employed, or even if you're an employee but you have other sources of income, interest, dividends, rents, maybe a K-1 from an LLC, a partnership, something like that, then you're going to have additional income that is subject to federal income tax and potentially Social Security tax, which is that FICA. It's very important that if you have this additional income and your tax liability will be more than $1,000, that you pay in your tax throughout the year. The IRS has set up quarterly estimated deadlines for you to pay in estimated tax payments. This allows you to pay that tax in as you earn it throughout the year. So the 4 quarterly deadlines would be quarter 1 is due April 15th, quarter 2, June 15th, quarter 3, September 15th, and then quarter 4, January 15th. So it's important to meet those deadlines to avoid penalties and interest. If you're paying in your estimated payments, there are a couple ways to avoid penalty and interest altogether. First off would be paying in 100% of your prior year tax liability. For example, if in 2024 my tax liability was $15,000, I made $100,000, so I owed about $15,000 in tax. Well, then for 2025, if I pay in $15,000, 100% of last year, generally, I'll avoid penalties and interest as long as that was paid in evenly throughout the year as I earned the income and met those 4 ES payment deadlines. The second option would be to pay in 90% of the current year's tax. So rather than paying in 100% of last year's tax, I could pay in 90% of the current year's tax. So you can pay in of these two options, whichever is less, as long as you've made those payments by those 4 quarterly deadlines by January 15th, then you will avoid penalties and interest if by April 15th, when you file that tax return, you've paid in the remainder of the tax balance that you owe. That's another important thing to mention. You can file an extension and have your 1040 extended from April 15th to October 15th. However, the taxes are due April 15th, which means to avoid penalties and interest, you need to make sure that your full tax liability is paid in no later than that April 15th deadline. Now, there is an exception to the lesser of the 100% of the prior year, 90% of the current year. And that would be if you are above 150,000 AGI, you would need to pay the lesser of 110% of the previous year or 90% of the current to avoid those penalties and interest. Now, what happens if you end up not paying in time or not paying in enough? On that difference, on that balance, penalties and interest would be assessed. And the longer that the time goes, the longer that interest is racking up. If you end up in that situation, there are some remedies to apply for penalty abatement, which we've done a video on, so check that video out in the description below. And the last thing I wanted to touch on was what's called annualizing your income. I mentioned before that the IRS wants you to pay in your tax due evenly throughout the year. That is the general baseline. However, some people have seasonal income, so maybe during the winter is really when they're earning the bulk of their income, and during the summer, they're really not earning as much. There's a form on your 1040, Form 2210, where you can actually give some details at each quarter mark, what percentage of your total income had been earned, which then can allow for a little bit of flexibility with when you paid in the bulk of the tax payment, and it can potentially reduce your penalty and interest if you were underpaid. So this is an important form for those people who may have that seasonal income. For those of you who are watching this, you know that you're subject to the quarterly estimated payments because you're running a small business or you have streams of income that are not subject to withholding, then it's very important to pay in your estimated tax payments. That's a service that we offer for our bookkeeping clients. Typically, we offer that service where we will project that each quarter and recommend an estimated payment for our clients. If you are trying to do this on your own, then what you're going to want to do is at each quarter mark, you're going to want to look at where you're at, project that out for the full year to see what you're projecting your business's net income to be, then calculate the tax that you would owe on that total and essentially divide it by 4 and pay in 1/4 of that. Or the really easy way to do it, like I mentioned before, would just be look at what you owed in the prior year, divide that by 4, and pay that in each quarter. That way you're paying in at least 100% of the prior year's tax liability. So if you found today's video helpful, please do give us a thumbs up, comment, and subscribe to our channel. Thanks so much.